Hey Shane, how's it going?
Busy, buddy. I'm busy, so we're gonna try our best to keep this brief, hit the high points, and move on today. How are you?
Doing well. Got my new coworker in the background playing the squeaky toy, so hopefully it
Oh
doesn't
yeah, how did
distract.
we
But
not get a picture of the little puppy into the deck? Maybe we'll have to pull one of those up before we go and show everybody the latest Kyle edition.
yeah, I think we'll get that in there next time. So,
There you go.
but today it's December 8th, and yeah, we'll kind of get through some of the high level topics here. But I think the big one, so we have the Fed next week, right, Shane?
We got the Fed next week. We got CPI the day before the Fed. So CPI comes on Tuesday next week, Fed on Wednesday next week. Imagine how bad it will be if CPI comes in higher than the 7.7 last month. Imagine how hard the market's going to sell off. I mean, who knows? Maybe it will, maybe it won't. I'm not saying it will. I don't know. I mean, I think it's like you roll some dice and
Yeah,
maybe you'll get an answer. But I I don't think it's I don't think it's impossible for CPI to come in higher than 7.7. Do you?
I don't know on that one. And what's always hard is higher going to take the market down, or is lower going to take the market up, or is it the other way around?
Dude,
It's
if CPI comes in hotter than 7.7, it's going to be like throwing a rock off a building.
yeah,
It's going to just sink. It's just not like in water. It'll be in air, like boom, straight down. If it
yeah,
comes in hotter than 7.7, look out, the market's going to sell hard. And I'm telling you, it could come in hotter than 7.7. There's no reason that it can't. I mean,
hmm
I look at all the internal data. I mean, let's see if rates are down, right? If mortgage rates are down, what did that do to home prices over the past month?
stabilized.
Yeah. So you don't have that benefit. What happened? Oil's down, gas is down, so that's going to be good. May not have helped that situation. So I don't know, man. I mean, 7.7 is a big number. I'm not saying it will come in higher than that, but it's not a 0%. It's like there's some positive percentage chance that that could happen. And if it does happen, oh man, the whole pivot narrative, those poor people will just get
Yeah.
smoked. Anyway,
And
we don't need to go through all these points on the screen again either. Sorry to interrupt. What were you gonna say?
I was going to say the narrative, or not the narrative, we're not so concerned about that. It's just what the Fed's saying. This is hawkish. It's not good. But you and I have talked about this. This is an age-old saying, buy the rumor, sell the news. And you've got a market that's rallied up ahead of this meeting into resistance. If I'm going to trade this thing, I'm going to short it.
We
Every
said
time. It's just that's the risk reward right now on that one.
we said that on the last call, I swear. We're like, hey, if we get the opportunity, I'd be shorting it, even though it was a holiday week. Or maybe that was the week before. I don't
Yeah.
remember anymore. The weeks all blend together. But
Yeah.
man, there's no reason to be in the bull camp right now. There's no reason to be aggressively buying stocks here. It's just asinine to even I don't get it, man. I don't get it. And you get like real professionals out there spouting this pivot nonsense. Like I'll tell you what CPI is not going to come in at. It's not going to come in at 2. And what that means is that the Fed is going to hike rates. I don't care if they hike by 50 instead of 75. You call me when a 50 basis point hike becomes dovish or bullish for the stocks. That's never going to happen, man.
Yeah.
It's a little less bearish. It's a little less hawkish than 75. But we've been planning on 75, or we've been planning on a 50 basis point hike for months. That's not even new. The whole market knew they were going to slow the pace. Um, so anyway, if you guys haven't had a chance to read the points on the screen, we went over them in a previous call. You can pause it, read through them. But out of 16 comments during the speech, the most recent Fed speech from Powell, only one out of the 16 could even be misinterpreted as bullish, and that's number 15. So, yeah, I think the bear market rally, this version of the bear market rally, has probably run its course, and the next move is probably lower. And you know, I don't predict the future. That's not what we do here, but that's my guess.
Yeah. And I tend to agree there. And, just another saying, we're just getting them all out there. But don't fight the Fed. And the Fed, they're not bullish on stocks, so why should you be? Right now is a good time to just manage risk and pick up some opportunities here and there. But
And this is just what they're doing with rates. This doesn't even include the balance sheet runoff, which we'll get to before we wrap up. So, um, yeah, there's just no reason to be aggressively buying stocks here.
no.
Crazy talk.
So, well, let's jump into the charts then. So we have the SPX up here. So this is year to date. And just look at these perfect tags of this downtrend resistance line, which coincides with the 200-day here. And then here we are. Look at that. We popped above it. But you and I talked about this. I wanted to see a back test into that. And then that was looking pretty bullish. And I would have expected this level to hold. So right around 4,000, it did not hold. We're down here at the bottom of this consolidation. And Shane, you drew this uptrend support. We're under that. We don't have it on here, but I just told you before the call. But if you look at the 9-day and the 20-day moving averages, you have a 9-day cross to the downside over the 20, and we're pinned right under that. So more than enough reasons right now to take a little risk off the table.
Yeah, I don't know. You and your CMT people might feel differently than me, but there's nothing. I didn't expect this to hold at no 4,000. I expect it to turn right around and drop hard, maybe make a fresh low. I don't see any reason that this SPX can't drop below 3,500 and make a new low for the year before December is even over. I'm not saying that it has to. In fact, if it doesn't make a new low, I think I'll probably start aggressively buying some stocks, because if it holds the low of the year and we project that the Fed is going to back off from raising heights and maybe raising rates in maybe March, um, they're going to start signaling that, and it might be a good opportunity to take a stab at some more aggressive positions. So, um, but I don't know. My base case is that we're going down. We're definitely going lower. That's my base case expectation. If we don't, I'll be very surprised.
Mm-hmm.
Doesn't mean the market can't bounce from here and try and suck in a whole bunch more money before dropping lower. I mean, they don't always have to look as clean as this chart looks, but this is a pretty looking chart, man. Every single one of these lower highs has coincided with a momentum switching to bearish and an extended or protracted downturn to a fresh low. So until that pattern changes, I don't know why to expect anything different here. I mean, yeah, we're above the 50-day moving average. Yeah, we're above like that low, I don't know, green candle from like middle of November, like right around this area. But to me, there's just not a lot of good reason to buy. This week is kind of dead. I mean, it's Thursday. We got tomorrow. I'm playing golf tomorrow, by the way. Market usually crashes when I play golf. So 11 o'clock Eastern time, tea time tomorrow. If I were you, I would short that. And that's just generally how it works. Dude, I don't know. I put this chart in here because it's just pretty. I mean, this is gorgeous to a bear. Like this is like just salivating. I mean, it's pretty, it's clean. Um, it looks like nothing but downside coming, and anything can change, right?
Mm-hmm.
But I don't know anybody who would rationally want to buy a bunch of stocks into the CPI print next week, into the Fed hiking interest rates next week. I mean, if you're going to buy something, probably don't buy tech stocks, just saying, because rates are going up. That's going to be bad for profitless growth companies. You want to buy Hershey and Coca-Cola and McDonald's and maybe Pepsi and AutoZone and, some stuff that's like recession resistant, fine, but we're heading for a recession.
Yeah.
I don't know that I'd want to be buying profitless growth stocks. So anyway, this to me says nothing but downside. Um,
I I agree. I mean, you're trending down, you're under resistance, and next week, like you're saying, I would not be aggressive going into that meeting.
yeah,
This is a risk off moment, and you got to look out for that. You can always get back in or do something after that meeting, but this is just setting up what it looks like to me is kind of a 4-to-1. You've got about this distance on your stop, and there's a target.
right.
So, but
Yeah, and eventually this pattern will break and we will go to the upside. It'll reverse. But
yeah,
I don't see any reason to picking bottoms gives you stinky fingers. That's all it gives you. I don't care to do it.
Nope. And then here's really the same chart, SPY ETF, but highlighting, year end 2020 right here, pre-COVID high. I still would really like to see that pre-COVID high get hit. We still have
Yeah,
not
man.
hit that.
Yep. I would love to see that come into play. I don't see any reason it shouldn't. Look, the economy is not better now than it was before then. I can tell you that for absolute certain. The
Hmm.
economy overall is in a worse place than it was pre-COVID. There's a lot of extra money out there sloshing around, causing the inflation that's now trying to come out of the markets or of circulation. Um, I don't know, man. But yep, this is basically the same chart with a whole bunch more lines on it. So, so anyway, a few more levels to kind of look at. As long as that SPY holds a 390 level, we'll see.
And
We'll
then
see.
this one here, so the Qs or the NASDAQ, this has just been a dog. We're not seeing really good rallies come through here. So relatively speaking, or relative strength, not really showing up here. I don't know that I want to short this if I look at that 50, but I sure there's nothing telling me to buy this thing. It looks like it might even go sideways in a few years.
Yeah,
It's
I just closed my short on the triple Qs today. I stopped out for a nice gain, so I'm on the sidelines right now. But if this thing breaks, if it makes a fresh low from like this current range that it's in, like I guess what's that? 1, 2, 3, 4, 5, 6, 7 days ago, that red candle, which is the low. If it breaks below that and then breaks below the 50, I will short it again in a heartbeat.
yeah,
In a heartbeat.
I
Yep.
tend to agree.
And I don't say there's no reason that today can't turn into a red candle. I don't know why the market's going up today. I don't see any reason for it to. We got some jobs numbers out this morning that were basically in alignment with expectations. Um, there's no reason for a bounce here today. The only reason for a bounce is because the market's gone down for the past like 4 days. So, and don't forget, last week the market was up one day. It was down 4 days. It was up one day, and the one day it was up for like 2.5 hours.
Hmm.
It was a 2.5 hour bull market last week. That's it. And then bam, the bear hits again. So I don't know, man. I'm looking for more downside. The Qs should go to the pre-COVID high. Why not? And then we'll see. So
Yeah,
that's what I'm looking for.
I agree. So we'll see, but turning down to commodities, oil, we've been watching this one and it was such a beautiful chart. And now it broke this level right here. So we had some pretty good support that it put in right there. I
Yep.
think that was just kind of right before Thanksgiving.
Yep.
We broke through that. Man, I'm not seeing support maybe down here. This is where we end up, $62, but
You know what I found fascinating about this, and that's why I added the yellow line and the yellow circle on the left. See that yellow circle and yellow line? That's year end 2021. So crude oil is down for the year. Think about that. Oil stocks are up like 70% for the year. Crude
mhm.
oil is now down for the year. So, you know, that's a very interesting juxtaposition, right? Are the energy stocks going to turn around and drop and follow oil? Or I mean, oil was up 70% at that high in March. Like from year end up to that spike, it was like up 70%.
Yeah.
And now the energy stocks are, they're lagging, they're dropping. They've come off the highs. Selling those covered calls at 95 was glorious, by the way. I wish I had sold more after I bought to close those for a nice gain. But yeah, I mean, oil stocks are still they're a little below the 50-day, and they're above their 200-day, and they're still solidly in an uptrend, and are literally up. What are we at? Oh shoot, I just did the wrong thing. Um, Let me see real fast. Where are we at? XLE is still up, 50% for the year. Meanwhile, crude oil is down for the year. So you guys know I don't trade crude, so I don't really care too much about this chart except for its impact on the energy stocks and sector. But this looks terrible, and no reason it can't drop to 62. I think if it drops to 62.40, most of the oil producing companies still make money. So I'd rather own the energy companies than the commodity itself, as always. But yeah, it's a fun chart to look at, though.
Yeah. And I was enjoying it through here and kind of that area. I was trading a little bit. Now it's just in a weird spot. So I'd expect maybe it comes down here, but that cartel and some of the fundamentals of oil escape me. So I wait for those
Yeah.
setups, and this
I mean,
isn't
it's
it.
you're still under the 200 day, you're under the 50 day. Both of those are declining. Like trying to catch an upswing here is just, I don't know. It seems like too much risk. I'd rather short it. I don't know. I'd just rather short it. And it doesn't seem to be that much downside. So to me, it's just kind of untradeable.
Yeah, agreed. So, oh, now, fundamentals, this chart, every time we bring this up, it's just like, man, is the sky falling? This is the inverted yield curve. Now we're at 0.84.
Minus 0.84.
Yeah,
Yeah.
minus.
It's just accelerating to the downside. I mean, we're talking about levels we haven't seen since the early 80s. Geez, I forgot to add the bear market that came after that. We're missing one bear market on this chart, which is what those black boxes are. But or recession, sorry. But I mean, there's a recession coming. If this is any good indicator, and it is, every time the yield curve inverts or the tens minus two spread goes negative, a recession usually follows within 18 months. Arguably, we've probably been in a recession since COVID, is my guess, absent all the just manipulation that's gone on at the government level. But I digress. I don't get to say when the official recessions are. But one's coming, and I think unemployment's going much higher from where it is now over the next few quarters. And I'm looking for a recession to happen. So even though, right, we might a little more aggressively go and buy stocks, that doesn't mean that a recession's not coming, and it doesn't mean that we got the all clear. It just means that you have to be able to keep track of competing ideas in your mind and keep an eye out for where you might be wrong and hedge appropriately. So
Hmm.
you don't find a lot of professional portfolio managers that have any longevity who go all in or all out on any one idea because
Right.
eventually they're going to be wrong. And if you were all wrong on something, that your career is over. So, and you lost a lot of client money probably, which is not what we want to do. So we're always looking for where we're wrong, and we don't have all of our eggs in one basket. So,
Yeah. And it's interesting in terms of the level of inversion. This hasn't been matched other than back here. And I think was that the savings and loan crisis
yeah, I mean, that's
back
when
there in the
Volcker
80s?
raised rates by however much in a day, 20% or whatever overnight in an emergency meeting, and
Yeah.
people started sending him death threats and what have you. So, and pieces of wood, like the lumber people and the farm and tractors showed up in Washington D.C. and people were like mailing him lumber. It was a crazy time to go study Volcker. There's some good articles out there that you can check out and read on that. And
Yeah.
I mean, that was a different time, man.
But yeah, I mean, the most inverted we've seen since the dot-com bubble, 2007. So it's a little scary when you look at it.
Yep.
So now here, this chart, it's just kind of been, making me scratch my head a little bit. Copper, Dr. Copper tells you kind of what the market's going to do here. And it looks really bullish. It's got some serious resistance to work through right here, but I was just wondering fundamentally why. We're not copper experts or anything, but I know some of the narrative there is, well, China reopening. Maybe that's saying something about it. You could be really optimistic and say maybe it's because we're not going to a recession. But I think you and I know maybe that's not the case. And maybe the fundamentals are just saying this chart is hitting this level and it could just roll over, go sideways. But just because this one chart is looking like this doesn't necessarily mean things are turning around, but it could offer a clue.
Yeah, and I would throw a little bit of cold water on your optimism there because it ain't that bullish until it gets above the 200 day and stays there, and we're still
Hmm.
below the 200 day. Got rejected, last time near the 200 day at about 396. Now we're at 388. We're bumping our head up into that 200 day again. Um, Momentum's been good for a few days, so this thing could easily drop back to the low end of the range down towards 337, something like that. And then when it gets there, it might break down below, and we could be, in a week or two, or a month, who knows? We could be looking at this saying, "Wow, that was a fake out and this thing's super bearish." So anything can happen down here below the 200-day moving average. We get back above that 396 area and then back test like you've been talking about, right? Maybe we pop up to 4 and then back test, and then the 200-day moving average will become support instead of resistance, and then a rally from there. I'd be with you saying this is super bullish. Right now, I think it could be bullish, but 200-day moving average is still pointing down. That is the long-term trend.
Hmm.
That number is the long-term trend to me. So as long as that's fallen, it's hard to get like, you know, green light on going all in long on something like this. But it could, it could happen. It could break out, and I don't understand, you know, the fundamentals of copper. I think the global economy is too interconnected and intertwined to have those kind of simple views anymore. It used to be
Yeah.
easier, but now I don't really know how much copper is used. And certainly I know building, people using copper pipes for water and stuff in their house. That's probably slowed down with the increase in interest rates. So I don't know what the copper is actually being used for now. And I'm not real sure that China's actually reopening. You never know. Those people seem pretty upset over there, though. I can tell you that much.
Yeah. So we'll see, but yeah, just a clue in there. But I agree there with you. We got to break that, come back and back test it, and then go higher to really change that view.
Yeah, it gets
But
above that 396 and then holds, 457 is on tap.
mhm,
That's a nice bit of upside.
you bet. So now the next one, so central bank balance sheet. This is, always important to go back and reflect on this because the Fed's raising rates, but they are also unwinding the balance sheet. So that has a additive effect to that rate hike.
Yep, that
So,
puts upward pressure on rates through the largest purchaser of bonds no longer participating in buying in that market. When the biggest buyer in any market goes away, the prices go down for bonds. That means as the price goes down, the interest rate goes up. So
mhm,
a few interconnected things there, but yeah, this is the biggest buyer in the bond market, no longer buying any bonds.
yep.
92
And
billion is a big number too, by the way. If you want to just go back real quick, 92 billion is the biggest reduction that they've had. They've got a cap right now of 95 billion, um, that they'll reduce the balance sheet by, and so that I'm actually impressed that they got as close to that as they did. That's the first time that I've noticed that many bonds actually maturing and rolling off the balance sheet. Um, so I'm surprised that they did that much, to be honest, and I'm actually surprised rates didn't go higher and bonds didn't crash a little bit more during the month of November. So it's pretty interesting to think about, and wonder like, hey, is the downside maxed out for bonds at this point? Like, should we be looking at buying some longer dated bonds? Because the long end of interest rates has definitely come down. So I don't know. I'm not anxious to go out and buy bonds because these guys are just going to keep hammering for as long as they can get away with it until they break something. So it's just interesting that the market actually handled the 92 billion drop in balance sheet pretty well, all things considered. And I just wonder how likely that is to continue, or if November was a bit of an anomaly. So we'll have to keep our eye on it.
yeah, and funny you talk about rates because here's the next big one. So this was in the Wall Street Journal, and this isn't new. Um, has to do with that yield curve inversion we've been talking about. But what
Hey
that means
Kyle,
is,
can I stop you real quick? Can you go forward 2 slides because our deal got a little out of order? Just go. Yeah, there you go. This is JP Morgan's expectation for a balance sheet. So you can see, how the balance sheet has changed over time, and you can see the QEs, quantitative easing periods in that box. But the forecast of the balance sheet is declining. And as we know, the market has done nothing but go up while they were buying and accumulating assets to add to the balance sheet. Got almost to $9 trillion of assets that the Fed owned and was buying. And now we're looking at reduce. We've only begun to reduce the balance sheet. You can see that this goes out 23, 24, 25. And it looks like JP Morgan is just projecting that they'll continue to reduce the balance sheet by about 95 billion a month. Um, whether they do or not remains to be seen. But you know, this balance sheet dropping has the inverse effect on markets, whether bonds or stocks, and also prices of goods and services. So we'll see how long they can actually do it. Last time they tried to unwind this balance sheet was 2018, 2019. And then, of course, we know what happened after that. COVID hit and they, loaded up the balance sheet by a larger number than they ever had before in QE4, right? They grew the balance sheet
Yeah.
by $4.7 trillion. So
And
crazy.
it's funny just looking at this chart for the first time, but look at this. So in '08, look at MBS as a proportion of the balance sheet. So they
Yeah.
bought a ton of those.
All the toxic assets.
Yep. And then here we are in 20. MBS never really ran off like they kept talking about. That was the
Yep.
big one. They were going to run that off. Didn't really do that. And now look at treasuries.
Yeah.
It just shoots up and I just noticed how small MBS got there and thought that's strange, but yeah, they're just adding one, debt instrument, after another onto the balance sheet. So I don't know.
Yeah.
I would like the Fed to stay out of this, but hey,
I wish they would, man. I wish they always would. Yeah, they're just let the business cycle do what the business cycle does. That's what made America great for hundreds of years. Just leave it alone.
yeah.
So
So
anyway, sorry, I didn't mean to get you out of order. You got to go back a couple here, and there you go.
all good. So the big one here and why I bring it up is, Wall Street Journal had an article out about this and nothing new here, but essentially what it is, when people leave their cash sitting in a checking or savings account, the bank wants to pay as little as possible to keep people holding their money there. Well, this is highlighting had they done something else, anything else, it seems, how much money was missed in terms of earnings by, people who are parking their money there. So I highlighted this, but right now, you don't have to go buy a CD. Yes, that's an option, but you can buy treasuries. That's a great option. It's the government backs those, but look at this, 6 months, you got 4.7%, 12-month, 4.65. Like those are really good rates. So if you've got any decent amount of cash sitting around, there are great options out there. And this article talks about most people don't do that because, the hassle of changing bank accounts. But really, this is open a brokerage account, have that tool sitting out there because, getting yields like that instead of zero from a bank, that's a really good place to go park some cash.
Yeah, they don't have the 9 month on there either. The 9 month is over 4.6%. By the way, do you know of any firms who do this for their clients?
Elevate. So we've been doing this. So, I don't know what other firms are out there, but we certainly have been doing that with some clients, getting them in this because, if you can park some cash there in a bear market and earn that kind of return short term, I mean, that's the key thing, short term. I never saw rates like this on a short term basis, maybe like 30 years out or something, but this is great.
Yeah, this is new for me, man. I mean, we've attracted a whole bunch of people's emergency funds and just open an account. It's not managed. It's never going to be invested in stocks. It's just for the purpose of buying and holding treasuries and having your emergency fund earn almost 5% in what amounts to the risk-free investment of U.S. Treasuries. So we stick to U.S. Treasuries that mature in less than 12 months. U.S. Treasuries that mature in less than 12 months are considered cash by most people in the financial industry. Even if rates go up a bunch, you're not gonna like if you had and you had to liquidate early, not hold your treasury to maturity, you're probably not going to lose much if anything. So there's not a ton of risk even if rates continue to rise. But I think we're nearing kind of the end of this rising cycle. I don't necessarily know that it's over and things
Hmm.
can change tomorrow and I will feel differently, but rates have gone up quite a lot in a short period of time, and so it makes a lot of sense for them to kind of take a breather. And so locking in some of these higher rates on your cash, even if it's only 3 or 6 months, then you get to like in the 3 month version, you get 4.24% annualized. And 3 months from now, you get the cash back to decide what do you want to do with it. You want to buy stocks because stocks have bottomed and they're starting to go up, or do you want to buy another treasury for 3 months or 6 months or 12 months because rates are still high and higher than a checking account certainly. So there's a lot more optionality on the 3 month, but if you know that you don't need the cash for 12 months and you'd rather get 4.65, well, 12 months from now, you get the money back. And you can either, go look at buying stocks. I think probably a year from now, there's at least a better chance that stocks will be higher and will have bottomed. And maybe you just want to put that money into the market at that point. But if not, maybe rates remain high and you want to just put it back into treasuries. So
Hmm.
these are not long-term investments. I mean, certainly you could go buy the 10-year or 30-year, but we haven't recommended anybody do that because, you buy a 10-year bond at 3.5%, and then rates double, you're going to lose a boatload of money, if you need to
Yeah.
liquidate, or certainly on paper on your statement. But again, one thing to highlight is look at the 2-year rate and then look at the 10-year rate. The 2-year rate's 4.29. The 10-year rate is 3.46. That's how we get minus 86 basis points on the 10s minus 2 spread. So
Yep.
that is abnormal, right? Like I wouldn't want to buy it actually really surprises me that more people aren't buying the 3, 6, 12 month and then the 2-year. And so many people, like, people are buying the 10-year bond. That's what is keeping the rate low. That's what's keeping the price high and the rate relatively low because people are out there actually buying the 10-year bond.
Hmm.
I can't understand it. I would never recommend somebody buy that 10-year bond compared to the 12-month bond. Um, so yeah, that's an interesting one.
It is. So, and now this one, Shane, you put this one up, so it's kind of funny.
It's just ridiculous is what it is. This guy's calling the bottom, right? The bottom is in. The never-ending bull market is over. No, I don't know. It's interesting. So we'll see what happens. Yeah, this article, if you click into it, it goes on to say that the bottom is in for this bear market. The guy had said the never-ending bull market was over back when it was over, I guess. So this guy, he knows a thing or two, but he's calling the bottom of this bear market cycle right now. We don't need to get into names, but this kind of stuff just continues to hit my inbox. And people calling the bottom, like, just people want to call the bottom. It's a great headline. It gets lots of people's attention, gets a lot of money to go back into the markets. But every single time I've seen this kind of stuff happen this year, it's turned out to be wrong. So
Yep.
just be careful on the headlines that hit your inbox.
And with that, Shane, we always have our Babylon Bee article and found this one. So husband weeks early in buying wife wrong Christmas present. So
Are you guilty?
this
Are
is
you guilty of that yet?
I'm about to find out. I think I've done well so far, but the good news is, so there's money going into the economy, so this does have an economic aspect to it. And, a lot of those gifts might get returned though. So it could be a wash.
That's funny. Yeah, I'm definitely there. I'm pretty nervous. I bought my wife a present. I don't think she watches this. I don't know. So hopefully she doesn't watch this one. But I bought her a present. She walks in the house yesterday with basically the exact thing. And I'm like, you got to be kidding me. At least I knew she wanted it, but
Yeah, that's good.
now she kind of already has it. And I'm just like, all right, back to the drawing board. What's up with that?
Well,
So
best of luck in that one. You
I
still
bought
got
the
some
wrong
time.
gift. I bought the wrong Christmas present in a different way, I guess. I brought the right one, but I was so right that she went and got her own.
Yeah. So, and just on the last note here, just everybody remember this is '08. We had the bear market. There are some serious rallies in the midst of a bear market. So keep that in mind out there and manage risk most importantly. So I think that wraps it up for this week, Shane.
Yep,
Anything
keeping it
else?
tight. No, that was good. I got lots of
Perfect.
work to do. We're really busy this December for some reason. So I'm gonna get back to it, but thanks for doing this and look forward to next week, man.
You bet. Enjoy your weekend. I'll see you next week.
All right, see you.